You ever look at a market chart and just see total chaos? Just a mess of lines going every which way with no rhyme or reason? Well, what if I told you there's a hidden roadmap, a structure, buried underneath all that noise? A map that could help you anticipate the market's next move instead of just reacting to it. Okay, let's dive in and see if we can find it.
We're starting with a classic for a reason. The legendary trader Jesse Livermore absolutely nailed it. He knew that the market is just a game of repetitions. Why? Because the emotions that drive it, fear, greed, hope, they never change. They're timeless. And because of that, certain patterns, certain behaviors just repeat themselves over and over again. The real trick is just learning how to see them.
But this brings us to the core problem for most traders, right? We're all rational people. We shop for deals. We look for value in every other part of our lives. But then we sit down in front of a market screen and something just flips. We start making these completely irrational, emotional decisions, buying at the top because of FOMO and selling at the bottom out of sheer panic. Okay, to really get this, let's use what's called the lobster analogy. Seriously, think about it. If you love lobster and you know it's normally, say, $11 a pound, what do you do when you see it on sale for $7? You get excited, you buy it, you recognize it's a great deal. But in the market, we do the exact opposite. We chase prices higher, basically buying lobster for $16, and then we panic and sell it the second it goes on sale. It's kind of crazy when you think about it that way.
So that's the big question, isn't it? How do we break that cycle? How do we start using that same smart value shopping logic from the grocery store in our trading? Well, the answer is pretty simple. You have to have a plan before all the chaos begins.
And this is where the pivot boss method comes into play. The core idea is that the market isn't random. Not at all. It has a structure, an underlying roadmap that the pros are watching and reacting to. The whole goal is to shift your mindset from a gambler reacting to every little price tick to an analyst who actually understands the map.
So the building blocks for this map are called pivots. These are totally objective support and resistance levels. And get this, they're calculated using just 3 simple numbers from the day before: the high, the low, and the close. And here's the magic part. This gives you a complete roadmap of potential turning points for today's session before the market even opens. It's your pre-market game plan laid out right in front of you.
All right, let's get into our first core tool for building out this map. This is all about finding what's called the money zone, the price levels where the most significant business is actually happening. At the very heart of the money zone, you've got the point of control, or POC for short. The easiest way to think about this is like the busiest, most popular street in a city. It is the one single price where the most volume, the most activity happened in the last session. It's the price the market agreed was the fairest for that day. Okay, so if the POC is that one busy street, now let's zoom out to the whole downtown business district. That's the value area. It's the price range where a massive 70% of all of yesterday's trading took place. This zone represents fair value. And this is huge because any price outside this area is immediately seen by professionals as either a potential bargain buy or way overpriced.
Now let's grab our second core tool, the classic floor pivots. These have a pretty cool history. They got super popular with old school floor traders who needed a quick and easy way to map out the day's key levels before the opening bell, without any fancy computers.
And that's exactly where their power comes from. The process is completely mechanical. You take yesterday's high, low, and close, plug them into a standard formula, and boom, it spits out a central pivot point plus multiple levels of support below it and resistance above it. What you get is a complete objective map for today, all generated before the chaos starts. It's pure data, no emotion, no opinion. Okay, so let's recap. We have 2 different maps, right? We've got the money zone, which is based on volume, and we have the floor pivots, which are based on price. Now, they're both useful on their own, for sure. But when we combine them, oh yeah, that's when things get really, really powerful.
The secret sauce here is one simple concept: confluence. Confluence is what happens when 2 or more completely unrelated tools all point to the very same price level. Think of it like this: your GPS, a paper map, and a local all tell you to turn left on the exact same street. The odds that something important is on that street just went way, way up.
So let's actually visualize how this works. First, we lay down our price-based map. These are our floor pivot levels, just simple horizontal lines of support and resistance that are calculated from yesterday's price. Simple enough? Next up, we add our second layer. This is our volume map. This shows us that money zone we talked about, the point of control, and the value area. This highlights where the real business, the heavy lifting, was done yesterday. And now, for the aha moment, we take that volume map and we lay it directly on top of our price map. And right there, see that spot where a key floor pivot line crosses over the point of control or the edge of the value area? That is a hot zone. It's a point of massive confluence. You've got price traders and volume traders all staring at the exact same spot for totally different reasons. The probability of a big reaction there, a bounce, a rejection, it just skyrockets. And we can even take this a step further. Just by looking at how today's pivot levels relate to yesterday's, we can get a good feel for the market's bias. For instance, if today's entire value area is sitting higher than yesterday's, that suggests a bullish feeling in the market. Or if today's value is completely inside of yesterday's range, that often means the market is coiling up like a spring, getting ready for a big breakout. But, and this is a big but, let's be perfectly clear about something. Having the best map in the world is absolutely useless if you don't have the discipline to actually follow it. And that brings us to the final and honestly the most important piece of this whole puzzle. I mean it. You can have the most accurate levels, the clearest signals, but if you let fear or greed grab the wheel, you're just going to throw the plan out the window and go right back to making those emotional, irrational moves. The real edge isn't in the tools themselves. It's in the professional mindset you use to wield them. So what does that actually look like? Well, it's having the discipline to trust the map you made when things were calm before the market opened. It's doing your preparation. It's having the patience of a predator, waiting for the market to come to your hot zone instead of you chasing after it. And maybe most important of all, it's knowing that sometimes the most profitable move you can make is to do nothing at all. And when you are wrong, and trust me, you will be wrong, the professional response isn't to hope or to double down. It's what Livermore said. You just have to stop being wrong. You cut the loss, you stick to your plan, and you wait for the next high probability setup. So I'll just leave you with this one question. Now that you've seen how this kind of framework can provide a map, are you going to keep reacting to the market's every little whim? Or are you ready to start doing the preparation that lets you anticipate its next move with real confidence? The choice, as always, is yours.